Good evening, ladies and gentlemen, to our live audience. Welcome to you to our masterclass and also to our virtual audience, which I'm sure you're all logging in right now. And this is our masterclass extravaganza, which is proudly presented by real estate investor with the ingenious minds next to me at Wealth Assist. They're here to guide you through creating wealth through real estate in impact investing. So you're going to be talking a lot about impact investing tonight, but we're also here to sprinkle a bit of joy for everybody, a little bit of humor, some new ideas into your day. Well, it's in your evening now, and you're going to delve into the fascinating world of real estate impact investing. And many of us don't know too much about it, but I can tell you what, tighten your seatbelt, you're going to learn a lot this evening. Those of you who don't know me, I'm your host, it's Liam Peterson. I'm the Chief Aficionado of all things real estate at Real Estate Investor. Since 2007, we've been shaking up the South African real estate landscape with all of our insights, and today we're about to take that up a notch to the next level. So we also look forward to your input to help us to take it to that next level. And I think we're on our sixth, I think it's right about our sixth masterclass already, 6 or 7. Yeah. So, and each time I think we seem to get better. We delve a little bit deeper, and there's just so much more sharing of information. But most importantly, it's about taking action. So I just want to talk about the agenda. So as I mentioned, we're here to tackle the ever elusive topic of trumping the downsides. We're not talking politics. No politics. Of course, Donald Trump, many of you heard of him. Some people may accuse me of name dropping, but I'm not name dropping. I went there to purposely interview him in September 2011 in Sydney, Australia, which I did. So I got to meet the man. But I wanted to find out about his real estate techniques and what he did. And that's why I interviewed him. I didn't interview him. He wasn't the American president for that stage. So we're going to learn a little bit about what Trump does, because he did extraordinary different things. And these are the things that we're going to be talking about tonight. So if you're doing just average things in real estate, you're probably not going to get anywhere. So we're going to sort of unpack a lot more on how we trump things, how we trump the downsides and make them upsides. So we're talking about securing predetermined returns, surfing the wave of compound returns like absolute pros, so that we're making money in real estate, that we're not losing money in real estate. It's about making money. And there's nothing wrong with making money. Nothing wrong whatsoever. Everybody thinks it's, don't want to make money, it's right to take the loss, but it's about making money. So whether you're a newbie and you're dipping your toes into the world of property investment, or a seasoned pro like many of you over here, it's a seasoned pro, too. So ladies and gents, without further ado, we're now going to get going with trumping the downsides. I'm just going to introduce our guest speakers this evening. Our first one is Daniel Lombard, and Daniel's the visionary founder and CEO of Wealth Assist, and he boasts a remarkable 35-year career in the property industry. And he's the driving force behind Wealth Assist. And Daniel and his team have earned a sterling reputation for their unparalleled expertise in direct real estate investments and impact investment. You hear a lot about impact investment tonight. Welcome to you, Daniel. Want to say hello to everybody?
Thank you, guys. Welcome. I trust that you're definitely going to enjoy the evening and learn some information. I think that greatest thing about events like this is those who are prepared to not take their talents and put it in the ground, but actually work with their talents are the one who, on the end of the day, are going to make good returns and those type of things. Those who, how do I say, if you don't buy the lotto ticket, don't expect to win. All right. So, I think you're going to really add some value to your knowledge today.
Wonderful. Awesome. Thank you, Daniel. Second speaker is Gerard van Westhuizen, who is the Direct Real Estate Officer. He has a 30-year track record in investment, financial planning, and the property development sector. Welcome to you, Gerard. I'm going to say hello to everybody.
Thank you, Neil. Yes, welcome. Some new faces, old faces. Thank you for coming tonight. I'm sure we're going to be adding some value. And our aim is to actually, every session, not only speak about ourselves, but in general, all learn from what we see in the industry and make sure that we're all on track with this journey that we started in property investment.
Great stuff. Gerard, thank you. And great to have you again as a guest. And our third guest speaker, and you can see he's not here live. And we've got our virtual audience over there. And his name is Peter Goosen. And he's, on a serious note, he's a very seasoned juristic officer with over 35 years experience in conveyancing. He specializes in commercial contract drafting, legal advisories, and his expertise spans property development, township establishment, and various legal aspects crucial. And the legalese is absolutely crucial, I will repeat, crucial to real estate, which makes him a pivotal speaker here tonight at the Welfare System webinar. So Peter, welcome to you. I know you're online. Do you want to just say hello to the audience?
I wanted to say hello. Thank you very much, guys. It's a privilege and honor. I'll say a bit more about the legal stuff when I get my chance. So then we'll talk about everything. All I can say from the very start is people tend to sign agreements without legal advice. And that is one of the biggest pitfalls in the property commercial industry. So talk to a lawyer at least before you sign agreements that you're unsure of. That is so important. So that you won't fall into the pitfalls of any agreement without consulting, just on a matter of fact, on something that you maybe don't understand or don't know about. It will take a couple of minutes, but I am for Wealth Assist and the drafter of most of the agreements. So you're always welcome to talk to me, and I can give you objective advice on what it means and the interpretation of any of the agreements. So you're always welcome. We'll chat to it now.
Wonderful. Thank you very much, Peter. Great to have you on board. Great to have a lawyer in the house talking about all the legalese and stuff, and we will hear from you a little bit later. Okay, so let's kick off. We're going to start off with you, Gerard. What are the strategies or approaches do you believe have the potential to trump the downsides in the realm of property investment?
Thank you, Neil. Look, in my mind, when you look at the first and foremost risk, it is what's against the board there, and it shows that there's no right deal for any investor who don't have the required cash or cash flow to protect the downside. I don't know how many people realize. I speak to investors wants to start this journey, who's already in this property game for quite a while as investors, and I see that they go for training sessions, they spend thousands on it, they put the structures up, all the future capital growth protection and so on. But what I see is that they actually are not focused on building a business in real estate. Because if you ultimately want to be an investor in real estate, you need to have a business in it. And there's so many aspects of it. And when you start speaking to them, I realize that they're actually only looking for what property brings from a capital growth perspective and from an income stream perspective. So if I look at them, I understand that, and they confirm that they actually don't want to start a business. They've got a business. They're in business. They are professionally qualified. They want the benefits and the risk levels that property brings, but they want to be hands-on. And when you go out and speak to all these people, you find that they're actually buying property that's very, what's the word? requiring a lot of attention, a lot of focus. You know, you have to speak and manage it almost on a monthly basis, and that's not what they were aiming for. But that's the reality. Cash flow is the blood flow of every business, as you know, and I believe that's actually the same to protect the downside as a starting point on property. So this slide is, you know, that man that was mentioned. You know, he's a billionaire in property. He's got 6,000 people working in his companies, and he said, "Know that there's no right price for the wrong property." And I thought about it. And if you think about what we're discussing tonight, understanding how to protect the bottom line. You know, when I speak to my clients, and many of them, I don't understand for the life of me how they can go into a property deal, have a negative cash flow for 8, 9, 10 years, and even more. So I don't think that, you know, people really understand, and it's a skill that we need to learn ourselves. We need to build a risk model for ourselves so that we can actually get to this point where we say that, but listen, to have a negative cash flow for 10 years on any property deal does not make sense. And I think that's where the wisdom of a billionaire investor is wise. I mean, you're actually paying for the wrong price for the wrong property. Ultimately, when you look at the numbers, and I think in previous sessions we made it very clear, the numbers speak for itself. We need to do the numbers, and if they say it's a good buy, and as Daniel would always say, it could be a very good buy, but not necessarily a great buy. And that's where we assist our clients to be that soundboard, to understand what the effect is on my bottom line over time. And that's where we're coming in. So I always think about this red light. You know, people saying to me in our consultations, they say to me, "But I haven't got any cash." And that's a red light. Then they say to me, "But I haven't got any cash flow." That's a second red light. But then I said, "But what have you looked at to buy?" And then I said, "Well, I looked at this and this from that developer because it's a that deal. I don't have to have cash. I can get 100% bond, but." And but then I say to you, but the downside is cash flow. And I think we should reconsider the extent to what people are using financial gearing, as I said previously. But I think here, this is the downside, to understand what the bottom line figure is when you do your figures and calculations. So with Wealth Assist, I really believe that we've put together a solution for the true investor. The investor that's actually not looking to start initially. In any case, I would advise not to start a real estate business, upfront. Rather learn slowly and get into the type of product that Wealth Assist is offering that actually brings a positive cash flow from day one and creates cash much quicker. That will become your net for the downsides into the future. And that's what we've been putting together. And I think we have hit the bullseye in terms of the downside from day one.
Wonderful. Great. So it's wonderful that I think investors out there can get a model from Wealth Assist that you could plug into. And there's a lot of work as an investor. If you want to go by yourself, you can go by yourself, but you're going to have to put in the hours to do that. So it's almost kind of that you hand over all the hard work, all the hard slog over to Wealth Assist. Yes, they do. Obviously, they take a bit of share, but you're still getting way above average returns. And you can still make that assessment for yourself. So, Daniel, I'm going to bring you in now. What additional risks beyond the obvious do savvy investors consider to effectively trump the downsides and secure returns for their real estate investments?
Thank you, Neil. Yeah, I think there's quite a lot. We'll try and cover the most important ones tonight. But we'll also, in our next presentations, we'll deal with that some more, because I think you get two types of investors. those who want to do it themselves, which I've got 100% respect for. If you actually have got the time and the money, because you're going to have to use professionals to do what you do, then in that case, go for it. We actually also provide a service for investors who actually want to do it themselves, but want some assistance. Okay, I've got investors here in the audience tonight that actually wants to go and search. They've got the time. They want to go and search their own opportunities. But what they are clever with and learned over the years is that they actually go out and find the opportunity, but bring it to us to check. Okay, that's all. So then we can look at it. We charge a fee for that, obviously, because we're going to spend some time on it, but you do save some money on it at the end of the day. If you don't, if you are credit rich and cash rich and time poor, well, this is the perfect answer for you. Okay, because we can actually provide you with all that assistance to the downside. Okay, because that's what we do every single day and every single transaction that we actually work. We actually see how can we mitigate. Now, it's just logical that if you do something for so long, you learn more. So for you to build that knowledge, which we've done over the last 40 years, is very difficult for you to get yourself into that position. Okay? And that's why we say, use our services. If the service as an investor effectively provides you a return of 70% net yield at the end of the day, after your costs, and you don't have to do the work. I don't think you have to do too many sums to make that decision. Okay. So even if you can get your own deals, bring them as well. But we can also add a lot of that from our perspective. And then the key with that is when you do good to others, the return are always good for you as well. Okay, so just keep that in mind. So the downsides that I'm going to touch on quickly is first of all, buy at the right price. That's the biggest problem, and Gerard touched on that. And please, I don't say don't buy to the new developments. There's lots of opportunities there that is actually good opportunities, but not all of them are. So you have to do your homework. I'm always saying the best test for you to say, this is my stress test. If I have to sell it tomorrow, after I bought it today, will I be able to get my cash back or my bond cancelled, cover the cost of the bond as well as the transfer cost, if there is any of that, it's not a new development or whatever. If you can't cover that, you can't cut the downside already. So that's your first test. Now that, unfortunately, kind of cancels about 50% of all new transactions out there for buy-to-lets. Because a lot of people buy at 100% of market value, or 95% of market value, pay extra, and on the end of the day, they can't trump the downside. Okay, they can't say, I can make sure that I bought and I won't end up with a negative return. Okay. So I think that's important. That's number one. Number two, if you have to exit, guys, property is not something that you want to share. Fortunately, actually, because the security is substantially better, in my view. Okay. And on the end of the day, but it doesn't take a day to exit. So you need to make sure that your sellability of that property, or worst case scenario, if you have to get stuck with it for another year extra, let's take COVID's time or whatever happened in that time. I mean, look at that time, a lot of our people had to extend their transactions. But on the end of the day, just purely because it was mettable, some of the people was able to move to a smaller place, rent out that place, and on the end of the day, just kept their homes. Okay, so those are the type of things which is very important. Needs to be sellable, and if you see what makes it sellable, it's in the right price range, which is affordable for a lot of people. Don't buy in Marvel don't even know if it's in the Free State or the Northwest, but Maribor is a beautiful town. But it doesn't mean it's a good investment, okay? Because there's not a lot of buyers in that town. So you need to be careful where you invest, area-wise, all those type of things. Because when you actually have to get it sold, you need to know that it's going to sell, and there's a big demand price-wise, as well as, and for instance, if we buy it at 5 million rand property, we don't exceed 60%. We won't buy higher than 60% because the drop on a quick sale on a higher price property is unfortunately more. You need to know those things. You understand? Then structural due diligence to make sure that you trump potential unforeseen expenses. Guys, if you have been in property and you've invested property over the years, I can tell you, everyone you can ask here, sometime in their life may have bought something where they didn't know the foundations was cracked, or the roof was sagging, or whatever that. I mean, we are experienced, and it happens to us as well. We see it, and then fortunately we pick it up because we send people in. When I looked at the property, I didn't think it was like that. But when I sent in the professionals to actually go and look at that property, do a full-on inspection, we do a full-on due diligence on the structure, on every single transaction that we do. So we make sure that there is those type of things. We avoid those experiences where you don't want to end up in that position. Then conservative use of finance. That is really very, very important. So if you, I would really say, if you can't cover yourself for 3 to 6 months, if you have to, and pay the mortgage while you're replacing tenants, while we're selling the property to exit or whatever that is, just be conservative with that approach. Make sure that there's enough equity in the property deal, there's enough time that you can buy with that equity to actually still get your capital back, still make a profit, and on the end of the day, come back with, you may even less than what you determined on the end of the day, but you make sure that you don't lose capital, because that's the key. Okay. Now, when you look at counter cost, there's the best-selling book in the world currently saying counter cost before you build a house, because it may let you look like a fool. If you actually work out, you're going to build this house, but halfway you can't finish it, then you look like the fool. Okay. So make sure that you avoid those type of things. Know what your transfer cost, your bond cost. For instance, in our case, maintenance. We do the quotations up front. We don't estimate. A lot of people, when you go and buy an auction, I did that for many, many years. I go to the auctions initially and I thumbs up. Okay? Don't work like that. I'm there quickly. That's not the way. So I bet quotations up front. What's the maintenance? How much it's going to cost? How long is it going to take to actually fix it before I sell it? Those type of things. Okay. Very, very important to trump the downside of potential losses. That's the way to look at that and calculate properly what you need to do and what. If you have a tenant in there, if you want to buy a buy-to-let, make sure the tenant has been paid. Don't let the other guy sell you a buy-to-let and you have to do the evictions for a 50 or 100,000 rand later. Don't buy a property on auction, then the real rates of taxes is actually 80 or 90,000 rand if you don't know. Those are the things which you have to verify upfront and make sure that you are covering those type of things. Then, obviously, Peter touched on that on the research of legalism. And he mentioned something which is very important. We pay for valuations. If it's a flip, we make sure that we add 3, you'll think of maybe we're going overboard, but we have 3 specialist agents in the area that do certain types of assessments on a predetermined format. Without maintenance, with maintenance, so we know what to spend, what will it add value, all those type of things get done if it's a flip. If it's a normal one, we own. If it's a recovery or a buy-to-let typical type of property, we will, in that case, we'll make sure that we, on the end of the day, just cover the basics of the valuation by bringing in a professional. Now, you would think all these type of things can cost money. Yes. But you know, if I take all of that, it will probably cost you between 12 and 15,000. That sounds like a lot of money. When you lose 150,000 or 200,000, you'll actually find out it's a very little, very small investment to make sure that you cover. All right. So to that, when I hand over to the expert, regards to the things which we talk about and the legalities.
Great. So there's some really good advice there, Pharaoh. Daniel, sorry, Pharaoh's yes, that's Daniel. So just for the audience's knowledge, there is going to be a follow-up webinar specifically focusing on the details. So we're not going to unpack everything, but keep your questions to the end. We will unpack as much as that you want to know tonight. Absolutely. But if we really want to go into the mechanics, it's going to be on Tuesday, the 12th of March, 12 o'clock, 1 o'clock, and Daniel and his team will actually unpack this in absolute minute detail. And that's when we really hone in. So if you want to take this next level stuff, you've got to be there, and that's Tuesday, the 12th of March. Peter, let's talk about what key legal and juristic aspects should investors prioritize when concluding due diligence in real estate investing to safeguard their interests and ensure the smooth transaction process. And I know you've got a lot of good ideas and advice, which you're going to. So it's over to you, Peter.
Thank you very much. I really do appreciate the opportunity. Just to come back quickly, you know, what we must realize, I think South Africa has most probably one of the best, if not the best, ground registration system in the world. You know, they have investigated a couple of years ago to change our deeds office system and replace it by title insurance. It would have been extremely costly. Fortunately, they walked away from that. And I've been admitted as an attorney in 1986, and ever since I've been practicing in conveyancing and commercial work. And I can tell you that we have got a very secure system. If your name is on that title deed, you can be very, very sure that it is your property and no one else can come and claim it, which is very important. And that's my job, to see that the legal owners deal with the property in the way they should do. And we as conveyancers take responsibility for that in terms of Section 43 and 43 and 44 of the Deeds Registries Act, as well as Regulation 15, which forces us and obligates us to take responsibility for every fact stated in every title deed. So what we do is, when we get an instruction from Daniel and his team, we do a deeds office search immediately, which is online system. We can immediately see who is the owner of the property, if there's any bonds registered against the title deed of the property, maybe if there's any interdicts or attachments against the property, so that we can all assess from the deeds office search, which is very important. Then we obtain a copy of the title deed, which is issued to us by the deeds office. Now, sometimes it's online, sometimes it's not online, then it takes a bit longer, but usually it happens the same day if it's online and the system is not offline. The title deed will show me exactly all the information I need for what the property was purchased, what date it was purchased, who is the registered owners, what bonds is registered against the title deed again, and most importantly is what title deed conditions they are registered against the title deed of the property. There can be right of preemptions, there can be restrictive title conditions, there can be testimonial conditions like fideikommissums or usufructs, or just a right to live or to stay on a property, or usus. So we need to look at the title deed conditions very carefully and see that there's no onerous title deed conditions, and that we give through to Daniel and his team. Title deed conditions, very, very important. You know, some of these developments in Cape Town, we got to get tenants in to say that the guys may not resell it within a period of 5 years after they've taken transfer. So if you come in that 5 years, you need to get the consent from the homeowner association or even from the developer. So there can be restrictive conditions, and that's our job to see what it is and to act against that. Or in terms of that, we can also see whether there's any interdicts, attachments, or preemptive rights, and all those kind of things. I've mentioned that. And then what is mostly important is to see the party who's selling the property. Are they or she competent to act? That is one of the essentialia of any agreement of sale, is the competency to act. In other words, if it's the company, whether there is a resolution, we do a company search to see who the directors is. And nowadays, you must also state the shareholders on the company register, which we haven't seen yet in practice, but it will come through. If it's people married in community of property, out of community of property, divorced, minors, it all makes a difference, and we must make sure that the guy selling the property or the person has got the competence to do that. That is highly important. There might be restrictive testamentary conditions like a fideicomissum, which might limit their competency to act. So we look at that. We look at companies specifically, resolutions, whether they are selling the biggest part of the assets of the company. Then you look at Section 112 and Section 5 resolutions in terms of the Sectional Titles Act. We look at trusts, whether there's resolutions. We get a copy of the letter of authority issued by the Lieutenant Master of the Supreme Court to see who the trustees are, and what does the trust allow them to do? Are they allowed to sell this property? Are they allowed to register bonds against this property? Because a trust is a creature of document. In other words, you create the terms and conditions of a trust in the document itself. So you need to take a careful look and do a legal audit on any trust document that you work with. Marital status, equally important. Married in community of property, out of community of property, unmarried, divorced, that all have an impact on the status or the competence to act of the parties involved. Then, if we take a look at the agreements that there must be, we make sure that all the essentialia of a valid agreement is included in any agreement that we conclude. And just for clarity's sake, the essentialia is basically the seller and the purchaser must both have the competence to act. The property must be identified or being able of being identified. The purchase price must be identified or calculated or being able of being calculated. And that is important stuff that gives validity to an agreement of sale. Of course, if there's suspensive conditions, the suspensive conditions must be met prior to the due date thereof, unless, and if they don't do, there must be an extension done before the due date. Otherwise, you will have to do a reinstatement agreement, because a suspensive condition has got the effect that the agreement falls away completely. So we look at that very carefully. Then we take a look at the National Credit Act, whether that is applicable on any loan agreement or transaction that's being concluded between the parties. And then we obtain the rights clearance figures from the local authority. Now, that is sometimes a bit of a lengthy process. So we start that early, not necessarily in Cape Town or in the Western Cape, but upcountry, we do have problems in getting figures from the local authorities. Then we must get levy clearance certificates or figures. If it is a sectional title, we get it from the body corporate. If it is part of home and association, we get it from the managing agent, because the levies must be paid before the transfer date in full. So we attend to that. We look at any registered bonds and outstanding balances. We request formal cancellation figures from any bondholder, being a bank or whatever it is. And then what we do is, depending on the matter, the way that your transaction is being put together, we register covering bonds against the title deed of the property, together with a transfer or forthcoming from a transfer, consequentially to an agreement of sale being concluded. We do a covering bond to protect the investor against anything that might go wrong. So what we do then is, if we do a covering bond, the title deed comes back to us. We can give it to you, we can keep it, we can send it to other attorneys to keep in trust, or sometimes we can just keep the original title deed in trust so that we have some form of security. So there is a couple of ways to fix or to make sure we have got the security of the title deed in our possession. If it's an agreement of sale, on an installment basis. We get the title deed endorsed in terms of Section 20 of the Alienation of Land Act, so that the purchaser is also protected and the seller can do nothing with the property whilst that endorsement is still in place and effective. So that is more or less, in short, what we are doing to protect the rights of everybody involved and to see that the transaction is being done in the right way, implementing everything that should be implemented and making sure that the registration process and the registration of the transfer or bond or whatever must occur is 100% in place, and there's no hassles or comebacks or whatever on the status of the transaction after we have done the transfer or the bond registration or whatever we need to do in the specific instance. Okay.
Bill, great. Thanks very much. Do you want to comment something, Donnie?
Yeah, I just think it's very important to know. Peter spoke about a lot of things there. In every transaction that we do, and I think that's very important. The services are there. They are actually sitting on our risk committees, making sure that these things happen. Okay, make sure that they are checked. Okay, that's the first place where they get involved. Then they draw up the agreements. Okay, make sure that the agreements and the master agreements are within line with exactly that. And then the best of all, there's the fees which they charge for doing it on every transaction. All the contract fees, everything is included in every deal. You don't pay a cent extra. Okay? So you can actually pick up the phone Peter and ask him, listen, I just want to confirm this. I'm not sure about this. Whatever that is, that's the important part. And the difference between a normal transactional attorney who does the conveyancing normally in South Africa acts on behalf of the seller. Okay? Like in our case, it's not the case. He acts on behalf of the buyer and the seller and ourselves. Okay? So it's a completely different approach. And it's not there for us, it's not there for the buyer, it's not there for the seller. He's there to ensure that this transaction actually takes place the way that it is intended to, according to the agreement.
That's a valid point, and I think all those details that Peter went through is critical, because you'll be amazed when people do buy properties that they don't go through that kind of thoroughness. And we just want to make sure. And I think, Donna, you mentioned it earlier, it's nothing worse than realizing you've got 150,000 outstanding levies or rates, taxes that haven't been dealt with. And so that's why it's so really critical to be able to go through. So thanks for that, Peter. I think it was fantastic. Carol, so what strategies?
I think the other thing.
Oh, okay. So
yeah, just the other thing that's very important here is that Peter is just going to run through.
Okay.
Where your money goes, and I've seen too many people actually pay their money into other people's personal accounts. Guys, when you do a transaction abroad, they don't do that. Okay, because you don't know exactly what the situation is sometimes. Always use it. Doesn't matter what transaction you're doing. Put the money to the attorney's trust account, because then you have confidentiality cover. But let me not run ahead of it. Let's give Peter the opportunity to explain how money is, how does the funds flow in an attorney's trust account? Because I think that's very important.
Peter, over to you.
Thank you very much, guys. Yeah, so what happens is, guys, and if I'm getting a bit technical, don't worry about it. I'm just going to run through it quickly. We run a trust account at Nedbank, at Standard Bank, and at Capitec Business, which is the old mercantile bank, in terms of Section 86(2) of the Legal Practice Act, which is our normal day-to-day running trust account. It's getting audited year by year. We must submit our audit to the Legal Practice Council, and then they only after the audit was yearly submitted, they issue us with a Fidelity Fund certificate to say that our accounts are all in order. So what you do is, if you put money into my trust account, you will put it in terms of my Section 86(2) account. Then you want me to invest the money on your behalf. So what's happening? It's interestingly enough, but we get the best interest rate at the moment from Nedbank. So then I want to invest the money on your behalf In other words, it goes into your name, still in my trust account, but you get your own sub-account under my PGI trust account. In your own name, it is in terms of Section 86(4) of the Legal Practice Act, and that means that you can get, say, for 2 little deductions, you get the interest on that investment. In terms of Section 86(2), the interest goes to the Legal Practice Council. We don't get it, they get it. We pay it over monthly to them. But in terms of Section 86(4) investment, you get the interest, most of it. There's a little deduction for our admin fee, and there's a small deduction that goes to the Legal Practice Council, which is legislation. We cannot get away from that, but you get by almost everything of it. And you can have statements on the account every month. It's easy enough because it's in your own name, and we can print you or mail you a separate statement on your own account. So what will happen then is, against the Section 86(4) investment, I can issue guarantees. So for instance, you're buying a property and the bondholder wants a guarantee. I can issue a guarantee against that investment. We gave them the guarantee that's payable on transfer. On transfer, they present the guarantee to the bank, and the money is paid out to the bondholder of the property, which you are actually purchasing. Important as well is that, and please note this, I cannot open the Section 86(4) investment account if you do not give me your FICA documents. Unfortunately, that's a requirement that we cannot get away with the banks. I open the account in my office, but I need to upload your FICA documents before I can do that. So what I usually ask is, once you've made a payment into my Section 86(2) trust account, please send me the proof of payment and send me your FICA documents so that I can invest it on your behalf as soon as possible, so that you can start earning the interest on that account. So on transfer, the money is being paid out in terms of the agreement of sale. If there's a balance, it stays with you. We can pay the interest to you monthly if you would like it. We can capitalize it and keep it there until you buy the next property. You can give me instructions in terms of your mandate and your instruction to invest the money, to do with the money what you want me to do, and I must be able to comply and adhere to your instructions as far as that money is concerned, and use it for the purpose that it was given to me. In other words, in terms of an agreement of sale or a loan agreement or whatever is the underlying contract to that. But all the accounts, our trust accounts, are protected in terms of the Fidelity Fund. It's a fund run by the Law Society and managed by them. In terms of the Legal Act, so it stays there. It's being monitored. However, at the moment, I cannot guarantee you that you will receive your money back if the bank goes into liquidation. You know, with the NBS, I don't know whether some of you are old as what I am, with the NBS lot of years ago, late 90s, early 2000s, when the Natal Building Society was liquidated, we had to receive a guarantee from the Reserve Bank to say that they will stand good for any money lost in the liquidation of the NBS. But with Sambo's liquidation, we did not receive any guarantee. So with Sambo, we had to take the money out as soon as possible out of the account. So that's your only risk, is that the bank will go into liquidation. And unfortunately, I cannot do anything about it, but hopefully we get a signal or a sign that's going to be a liquidation of a bank, which is hopefully not very likely in South Africa, because I think we've got a very strong and a very good banking system. Also one of the best. I think if you take a look at the foreign banks, they really rate the South African systems. So I think we've got good banks. I've got no worries about that, but that is basically your only risk as far as the money is concerned. Anytime you need statements, you call the office, we send it to you. Whatever you want to do, you can give me instructions and I will do it for you. And say, for instance, you resell the property and you made some money. You can tell me, listen, invest it again. I'm going to use it for the next transaction. You can tell me to pay it out. You can tell me to invest it for 32 days, for a month, for 3 months, for 6 months. Depends on when you're going to need the money. That, of course, gives you a better interest rate if it's for a longer period. And that is, in short, how we run our trust accounts.
All right. Thank you very much, Peter. That's very comprehensive, and I think so important, right? That we keep our money safe, and now we start looking, we're doing a DIY by ourselves as an investor, and we could start seeing where we go wrong and not necessarily taking good advice along the way. And we tend to say, we see this property, we've got this fantastic return. Excited, and and of course, we're emotional people. We buy on emotions. We cannot take that away. But we've got to look at the numbers, and we've got to look at the process in conjunction with those emotions. As much as possible to follow that first. Right, so moving on, Gerard, we now going to be talking about lock-in return. So what strategies and tactics can we employ to effectively lock in predetermined net returns?
Thank you, Neil. Yeah, I think, you were speaking about having a goal, and people will come to us and say, listen, I want to retire with 100,000 rand of income per month. What do I need to do? And then you calculate quickly and you see, I need about 15 flats. And then they start buying 6 flats at once and overextending themselves. And then they show me the cash flow and I say, I'm, as I said, 24,000 rand a month, shortfall. It says, okay, so what I suggest we do is we actually go a bit slower. And we understand that there is a certain risk that you take. But what is very interesting is that everyone focuses on the upside. We see the 15 properties in the future. We're smiling all the way. But I think the journey on getting there should be, looked at much carefully. So, in this instance, I think we are the only company who offers contractual predetermined returns. So many people will ask me when we speak about on the phone or online, and they say, but how do you do it? And I says, no, you negotiate it. Actually, very clear. There's a seller and there's you as the purchaser, and we negotiate the returns that will be paid out to you during the phase of investment and at the end of when you sell it. And I think, we've spoken about it. To have a balanced approach to investment, you have to have the right property. We know this. You have to have cash. You have to have good cash flow on it. But more importantly, and this is the last one that I want to add, is you have to have an exit. How do you get out to realize your returns? And I think that's where we come in. And after the negotiations or doing the calculations, in our model, it's called the feasibility of each deal. We actually work out what will work for both parties involved. And then we bring it into the agreements. You sign as the seller upfront and as the purchaser, aka the investor, upfront. There's no uncertainty. So if you want to trump the downside, make sure that you know exactly what the downside will be when you buy a property. Even if it's a normal residential property and you do all these speculative and assumptions, one after the other, there's quite a few that you actually enjoy. And I'm telling you, I get very nervous when we do this, because I understand that, when you say to a normal residential investor, you'll have a net return, you'll have a gross return of 10%. The net return after cost will most likely be 6%. So 6% is below inflation. You've spoken about inflation. And then I said, but just understand, this is not a good one. This is actually below good. And there should be another option. And that's why if you can have a contractual predetermined return in your agreement, and you know, this is what you will earn on the downside, I really believe that the upside will look after itself. And the reality is, if you want to get to that level of having a real estate business, because you are such a level of investor, you have to build it over time. It takes time, there's no doubt. And you build in all the safety, into your risk model. You build in all those aspects that will make sure that you actually don't lose. And you have the ability to spend 15,000 rand before you buy, because then you know that there's no surprise. And with all the laws in South Africa today, there's Peter now explaining us to, can you imagine to what extent they go to actually, and you've seen it around the table, how many times that there was a rate, you were speaking about a rate that's behind 100,000 Rand. Never when you sign the agreement, it's mentioned. It comes up when you want to take transfer. And we ask the figures, and then you see it again. I really, and remember that other one, we wanted to do a deal, I think it was the first 8 years, they couldn't sell it.
Yeah.
So we in it, the investor is buying already. There was an 8, I think he was in,
We picked it on the title deed,
yeah,
but you can only sell, Peter mentioned it, only after 8 years. So we went to the government, made sure that the cost, they went to the system plan. But that somebody had to go do that.
Yeah.
Like you would have bought that property without a doubt, thought I could quickly sell it on, and bang, the 8 years wasn't finished. You start. You can't sell that property. Those type of things, you know, whoever of you have bought the property and actually read the title, that's the problem. We read every single title. You'll know when we sit around the risk committee, we have reviewed the title. And we've looked at it. Christelle sits here. I've received you guys. She goes through every single title and gives through to Peter what is the stuff that she believes is a risk. He researched that. You know, so those type of things. If you have to do it on every deal, the fortunate thing for us is we do it on all our investors' behalf. I think that's the important part. We can afford to spend the money because one of our investors is going to buy this property and we have to protect it. That's the difference. Okay.
yeah. So on the title deed, when the client comes and says to you, I've lost my title deed, my property is paid off. It's 3 to 6 weeks later before you can continue.
Yeah.
Because no one lost the title deed. But just to conclude, Neil, I think to trump the downside, you plan for it. That's the reality. We plan for the downside, then you won't have. That's possible.
Wonderful. No, I think that's a great analogy. And what I also like is the whole flexibility to get those predetermined rates. You can negotiate, guys. So you still got that opportunity to negotiate what you want and what your returns are. And I think that is really an upside. And I'm not just looking at one of these banners here, 17% plus per annum. I mean, you're not going to find those kind of returns quickly and easy. To put that onto a banner, I think now you know exactly where you can start negotiating. So those are the numbers that we're talking about. So Don, you're going to talk a little bit more and shed a bit more light on how we can achieve the seemingly too good to be true aspect of your offering, because all these people sitting over here and those online, and we're going to give you a chance to ask lots of questions online, guys. And we want to engagement because that's probably the most important. How many have heard it's too good to be true? Who's heard that? So maybe, Donna, you can just elaborate a little bit more. Now, what are the concrete steps and strategies do you recommend for investors to realize the potential of your proposition that is too good to be true?
Okay, right. I just first want to say about too good to be true. It's only too good to be true. If there's not a track record, like in our case, we can actually show you a 10-year track record of audited returns. Okay, so only then, when you research that, you can determine, then tell me it's too good to be true. Okay, so there's a reason why we can actually do this, and you mentioned that in the beginning as well. The key is everybody has got a win-win. This is what makes it different. Okay, because there's an owner that's assisted in the process. So he's selling at far below market value, which is the first key. Okay. We don't buy properties higher than 75% of market value. All costs included. Maintenance, transfer fees, everything included. So how's that possible? Well, like Neil says, you negotiate. But then you need a cooperative seller to want to do that. The only cooperative seller is if you don't misuse or use his misfortune to enrich yourself. So if you're actually going to help the person, he's prepared to walk the road with you. And there's ways that he can determine that it actually works for him as well. Because he gets capital growth on R1 million while you buy his R1 million property for 500,000, so he can't settle all the debts and he can actually recover. Things like that. Okay. So that was make a difference. Not going there, oh, this guy's house is going on auction, so I'm going to try and steal it here for 40 or 50% beforehand and misuse it. Then it's going to be difficult. He's going to stick in the property. You're going to have to evict him and a few other things like that, instead of having to work with the client. So that's number one, is buy low, buy a profit, buy a risk of a potential guy not want to move out, those type of things. You need to calculate really pay the price. Yes, the property as security. Now, this is very important to use the underlying assets in various ways that we use. So property is an investment vehicle, guys. You're not going to live in that house. Okay. So it's an investment vehicle. And most people can't make that mindset. Oh, okay, this is actually an investment. It's not I don't like the green door, the big garage door doesn't, it's not going to sell quickly, Move away from that. Okay. Look at the returns, look at the area, look at what, to be honest with you, I made the most money on properties in yesterday. Now, if I ask anybody here, would you have bought it yesterday? A lot of people would say no. Okay. That was the greatest capital growth when the new government came into being and where we made lots of money. So that's it was because it was affordable, people could afford it to buy it. And a lot of people were in the government where they have subsidies, those type of things. Then secure, now this is a very interesting one. Secure the prime connected rental income. So when you put somebody into a lease agreement, you can't do it with everybody because all tenants won't sign for it. But a guy who wants to buy back his own property on the end of the day is prepared to sign a lease or a triple net lease, like we call it, where he pays the maintenance. His rental is connected. Just remember that you buy his property. Let's just use an example of 500,000. You buy a R1 million property for 500,000. Now the rental at prime is still far below. If you take prime plus 2, so that you be in a positive cash flow from day one. That same property's rental is lower than what the market rental is for a R1 million property. So you're getting a lower rental. So if something goes wrong and that person runs away, you can put another tenant in there to cover your costs. Okay? Those are the things that you have to look at and negotiate that up front with the people that wants to recover in the process. If it's not somebody who wants to recover, then it's a tenant. All tenants are not prepared to do that. In the commercial industry, Neil will tell you, it's actually working like that. People, I pay here for operating costs. I pay part of the rates and taxes of it. So that's the situation. Secure your returns through impact. Let it be a win-win, as I said, to everybody. That means the previous owner, you make your profit, we make our profit. The agent who sells it make his commission. The people who do the collection make it. If everybody works, not for free, do their best, they'll do it properly. Last one is contractually secured returns. Every single transaction done, make arrangements which is not contractual. But, for instance, just to make it very practical. If you put the property, we sell a property, if we say that you're buying a property with a permit to on-sell, or even if the person defaults, we say, this is what it's going to be listed for. This is the price that we can accept without asking you, Mr. Previous owner. Then we will drop the price to this, and then we can accept this. And if it then doesn't sell after a year, we can put it on an auction, and we can accept this. Or you can keep the property by paying him so much extra. So all those things are built into the agreement. So you are well protected. You know exactly the exit strategy that you need to do that.
Right, thanks, Daniel. Okay, so just quickly, just to elaborate how this can be the power of compound returns. Just want you to just touch on that one. For the audience, get your questions ready. Are the questions coming in there, Christian? They're all coming in. You get your questions ready. I'm going to give you just a chance, maybe 2 minutes quickly. Just give us a wrap and we can get straight into the Q&A.
Right. The same as I said, try and make the mind shift that property is a vehicle to do your investment. Don't buy into hold. It's not true that it makes you the most money, because the only compound returns is you have to exit, get the capital plus the returns out to actually reinvest it. So if you do that every 10 years, and I do it every 2 years, greatest compound. It's a simple question. It's not guru stuff or we do some magic or something. It's just we use the ninth or seventh wonder, whatever they call it, compound returns. And this is just a practical example of compound returns. At our average of 2-year transactions, if 2 people start with $1 million, okay, you can come and discuss it with us in detail. It's not the time, but there you'll see the one guy ends up with $4 million worth of capital and returns after 10 years. By keeping the property, you'll probably end up at about 2.7 million. You can choose whichever way you would prefer to go. And both of them had property all the time during the same as security. You only had one. The other guy had 5 different ones. Okay? But his actual value of those properties comparing to market related was even more than yours. So which was the best investment? Very simple. Great.
Great, thank you very much. So I just want to remind the audience again, Tuesday, the 12th of March at 12 o'clock, you'll learn the full turnkey way to invest with Marcus. Okay, have we got some questions? There is the banner for that, just so that everybody can see. You can take out your phones and you can click if you can, and there's a QR code there on the top. We'll show it a little bit later if you didn't get it. All right, we got a question from AD. Hi guys, where does one start if you have no knowledge at all? Who wants to say? No knowledge.
Well, you start with us. And the reason being is very simple. We haven't touched on it tonight, but we are actually joint venture investors. We put people together and we bring all the operational knowledge, infrastructure that you need, and we will actually show you. We are not there to train you or build structures. We are actually there to invest with you and make an appointment, and we'll quickly show you.
Great, and I just want to add, you can read the Real Estate Investor magazine. You can go to RNI, you can attend all our events. You can read lots of books. Go online. We have a number of webinars, and in that virtual world, you can actually go visit. All our products are actually in that virtual world there. So it's a metaverse, and a metaverse is a place where you actually engage, and it's just very similar. We've got a virtual world there. For those that are on the Zoom platform or Teams, that's a virtual world. That's just a different virtual world where you're an avatar and all the product is there. Other good news is we was hosting Robert Kiyosaki is coming to Cape Town and Johannesburg, by the way, mid-May and end of May in Johannesburg. He's coming to Cape Town first. It's a weekend. It's a Saturday and a Sunday. We will announce that probably very, very shortly within the next week. So go and see Robert Kiyosaki, go see these people. You can learn from them, read their books, but at the same time, I agree with Gerard, they're the ones that are the transactional guys, and it's always good to start first to get somebody and invest with somebody like Gerard and Daniel first before you start taking the plunge. Okay, next question. Can you just put up that? Yeah. Can I buy a property that was supposed to go on auction before it is auctioned? For you, the auction specialist, Daniel.
Yeah, you can definitely do that. I think that's what I actually try to explain now. When there's an auction, don't go and try and buy the property. If you phone the guy, I'll just use a practical example, which happened many times. I'll phone phone the client. Oh, you know, you're number 12 that phones me today. You know, I wants to buy my property. I said, no, I didn't phone you to buy my property. To buy a property, I want to ask, can I help you? Why? Now to keep your property. Really? When can you see me? I'm number 12. Okay. But nobody else asks that. Everybody asks, can I actually steal your before the auction? You know, that type of thing. And with respect to everybody, every investor out there, great stuff. If you cannot get it to actually get it right, it's good. If you do buy upfront, I will advise you to get some advice. Because when a property goes up sale and execution, there's a way to stop the sale and execution. And everybody, unfortunately, doesn't know that. They don't know how to stop an auction. So you have to contact the bank, make the offer to the attorney on panel that's actually dealing with that. And those type of things you need to do. Because if you do it right, you can actually buy it at a good price. But still do your homework as if it's a normal transaction. Still review the property, the structure, all those things that we mentioned that you still have to do.
Right. Okay. And I see there's a lot of questions there for recordings. Yes, there will be a recording. Yes, there will be a recording. And just in case you were not sure, there is going to be a recording. Okay. So, and it's very important. We always load them up onto our website. And I know also Wealth Assist also load these onto ours. So we've got a lot of content there that you can consume over there. Okay. So if a seller is in financial trouble, it's a great question from Dylan Swartz. What guarantee is there he will pay the ongoing expenses?
Now, most people are in trouble because they've got a lot of short-term debt, not because of their mortgages. So what they did is they ran into some trouble, start taking up short-term debt, and suddenly we've got people that comes to us that have no mortgage on the property, not at all. But they've got 500,000 rand of short-term debt. Now the problem is the bank can't give them a mortgage anymore because they're overexposed. So what we do is, and unfortunately the bank's not allowed to lend the money. That's against the National Credit Act. If you are overexposed, the bank's not allowed to lend the money. So in that case, you will buy that property, unlock the equity first, settle all the short-term debt, making sure that the person's cash flow can actually carry the payment. And that is where that specific question is addressed. If it's not possible, we will never advise a client to do with us what we call our buy these kind of transactions, because it won't be a good thing for him. We are rather selling, in your case, you have to sell the property, rather get the money out, go a bit smaller, start afresh, and we'll help you with that. But that's the way that why we can actually help a person with you today. He can't afford to pay his loan, but actually tomorrow he's able to actually, we test what we call a before, during, and after on the cash flow every single time before we approve them on the store.
Great stuff. Okay, Musi, as a beginner in property investment, is it possible to buy a property on a buy-to-let basis by taking out a deposit and paying monthly installments towards the total property price? So this one clarifying, does he mean paying towards the deposit, or is he talking, because you gotta pay a monthly installment on your bond. So the question is obviously, and I disagree. I mean, banks are giving 108% loans. It all depends on the type of sort of investment it is. So there's a lot of flexibility, I think, and it depends, I think, obviously on your credit score and your ability and that kind. So I think, I don't know really to elaborate kind of more on that one. Let's go to the next one. If you are credit rich, how can you get involved with Wealth Assist to buy using bank financing? And that comes from Brenda.
Yeah, look, I mean, our deals can be completed with bond finance, and there's no doubt. And I think the biggest advantage is that positive from day one. So without any doubt, the QR code is a good starting point that you can have a meeting and go through the process of it. And we actually do, as part of what we offer, we do an investment plan, and we build in whatever finance model you will be using. We actually bring it into that plan, and you can actually see the calculations and the projection of what will be happening. It's very clear, so we can assist you there.
Okay, great. I can just maybe use an example. There was just, we even have investors who actually include the costs of the bond registration if you don't have the cash for that. It's not always recommendable, but if your credit rating, you will use the maximum credit. Remember that your exposure together with that cost will still be lower than 75% in total. So it's not an issue. We can actually do that for you.
Excellent. Good. Next one, question from Stephen. And this is related to buying a commercial property. When buying a commercial property by leveraging your current assets for a loan, does one look at buying at a price that the bond is covered by the income? Now, this is a commercial property. It's not directly in your particular zone, but I would say commercial is a little bit more complex. Normally, you buy in a company. So it's not just your personal assets. You would definitely buy a PTY Limited or even a trust, but ideally, probably a PTY Limited with the shares of the company owned by a trust.
But can he leverage?
Can he leverage?
Yes.
It gives you lots of flexibility.
Yes.
And I think that's really what the thing.
Absolutely. The question sounds like is, can you leverage your current assets? Definitely, without a doubt. The great thing about that is we do have a lot of residential property and not commercial property. We leverage over 20 years, whilst if you would have taken out a normal mortgage on a commercial, you would have done it over 10 or 12 years, which means your payment is much higher, which in that case means that if you've got a good leases, because that's the key on commercial, just make sure that you have proper leases, long-term leases. That type of thing is very important. Your escalations must be correct. It's a bit more complex than residential property, but we can assist you if you need some advice on that.
But also, the first question that comes to mind in my mind is the amount of cash that you need to put down. I think there's other solutions that you could consider, Stephen.
Yeah, that's normally about 30%. I think sometimes you can get away with it. Depending on the property and that kind of thing. So there is quite a big down value. Yeah. Okay. So then we've got Klaus. Okay. Can you invest with land? You don't have cash. That is, you have land that you want to develop. Can you come into a joint venture with me?
It's not really with it's guys, developments, I'll just round it off like this. Depends on what is the size. Okay, first of all, we prefer not to get involved in large developments. For a start, if it's not rezoned from day one, be very careful, because currently the government, municipalities, etc. I don't want to even use examples, but we had this piece of land in the middle of one of the most beautiful spots, everything. It's 9 years for his own, because they took away our access road and sold it to the next door developer without our consent. Okay. It's just a simple thing, but it's 9 years later. Would you love to be a developer in that kind of deal? No. Okay. So, yes, we can look at that, but we'll do it only if the rezoning is in place and there's already the necessary things that we can actually determine. And your land must be paid. We don't do transactions on vacant land. It needs to have some potential or upside and probably some contribution your side to make sure that we still stay under the 75% of exposure to market value for those units that you can have.
Now, I would stick to the impact with wealth assist. And with respect to Daniel and to Gerard, it's just, I think, also, of course, it's great. There are joint ventures available for that kind of thing. There's a lot of developers looking for land, want to develop. So yes, you can. You just need to find the right partners. And then, of course, you've got to do due diligence on your partners as well. Because you don't want to end up with the wrong partner. So very much like Peter was talking about earlier, about doing your due diligence on the property, you probably have to do similar due diligence on your partner.
For sure.
So that's also quite important, especially if you're going into a thing like with land. Okay, and then we've got one more question, Stephen Rottenbach. He said, it was mentioned that you buy at 75% of market value. However, 75% won't cover the bond at prime of 11.7. I think it was 7.5%. Well, Stephen, we know that interest rates are at an exceptional high at the moment. They are going to come down, and it will come down.
But that's not, I think
I just want to mention I want to comment just on the interest rates. I'll let you comment on the rest. And I think if you can buy at a high now that where interest rates are sitting and it's going to drop, you're going to get that benefit. But I'll give you to answer that.
No, I can see that, Steve, the situation is that you are just using the equity,
Yes.
comparing to the interest rate. So our leases are all prime plus 3% or prime plus 2 minimum, which means even if you borrow 100% of your mortgage or of the amount, okay, then in that case, your rental income, your net rental income, not your gross, your net rental income is actually prime plus 2. That means you're going to get 13.75% payable on a monthly basis, and you're going to pay 11%. Are you positive cash flow? Yes, from day one. So that is not the issue. So the 75%, or why we say the 75%, that provides you additional security because that's your equity that you got in this property if you have to sell it quickly and cover your capital plus the returns. So that's the explanation for that. Hopefully that answers.
Yeah. Okay. Daniel asked me to ask a lot of questions. Unfortunately, I don't have a lot of questions. Just one question.
Good one.
Yeah. I hear you. It's nice and good. Do you have someone in the audience that has been with you for some time? Just to okay. Just to wow up.
Very well.
As for myself, I'm glad that, and I can speak on behalf of my wife as well. I'm glad that I have Daniel as my backbone, a person whom I can trust, a person whom I can go to if I have any problems. I can talk about his products, I can talk about outside products, and he's open to suggestions. I think when he was talking about earlier, he was talking about the opportunity where a person can go outside and look for deals and come back to him and check. Unfortunately, I think he's referring to me. I don't because what I was looking at and being in an investor for such a long time, he brought a important key to my attention, which I needed to have considered. And the thing that I had to learn was that I did not include, if I had to lose the property, if I was able to, in other words, I did not consider the costs involved. I thought that was not something that I needed to consider at the start. But if I had lost that property, would I have been able to make my money back? And that is where his expertise came in. So, yes.
How long have you been with us?
6 years.
6 years.
Wonderful. I think it's a nice way to finish. So I'm going to just say, Gerard, give us your 1 minute wrap takeaway that everybody can take away with tonight. And then Donna, I'm going to ask you the same, but you only got a minute, Donna.
Thank you, Neil. No, I appreciate it. Look, trumping the downside is the number one principle for me. Looking at your cash flow risk is very important. And I think ultimately planning for your upside and your downside is a key, and it's a principle that you should not waver on. So thank you guys for being here, and hopefully we will have many discussions on your own portfolio very soon now.
Thank you very much, Gerard. Daniel?
Yeah, for me, I think impact investment is very important. Make a difference in other people's lives, and you always make a good return. And I think what we can add is making sure that those investments that you do are just properly researched. And a bit, I don't want to say more than you, but we experience these things every single day. And the fact that we know what to look for. We look for the specific pitfalls and those type of things, which you may not know about, or even if you are a seasoned investor, that you may miss a specific transaction. And we can always assist with that and make sure that we give you proper returns over all cycles of the property cycles that you go through. And I think that is our part of that.
Great. Good. Are you back, Peter? Your final thoughts? You got a minute?
Yeah, sure.
Your final wrap? Maybe just give the audience some final thoughts just to take away with it.
Yeah, just one last thing from my side. I think what is important is that a relationship in the property industry, it's important to build a relationship with someone that you can trust. And it is a matter of beginning that relationship somewhere and to give it a chance. So building up relationships to me in the property business is extremely important. And I think that must be the aim also, that if you want to decide to work with Wealth Assist or whoever, that you start building a relationship with him.
Wonderful. I think those are very wise words to end off over here. So thank you very much, Peter, for your contribution. I think it's been valuable. I think it's been fantastic information. Once again, I remind you, Tuesday, the 12th of March, please join. I won't be there. The team it's all about Wealth Assist now. We're going to deep dive into the different investments. You can either go onto the REI.co.za, real estate investor website, and go onto Wealth Assist, and you can register there. It's free. And it's free. Just think investing and education is free, guys. So what an opportunity. You've been a fantastic audience. I think give yourself a round of applause. Thank you.